The dust settled, the voting booths have been packed away, the sausage sizzles have cooled, and the Albanese-led Labor government secured another term in office. But what does that mean for Australia's property markets? That's what we're going to discuss in today's episode of the Michael Yardney podcast, where twice a week I try and bring you some clarity in the chaos of all the confusion that's happening in our housing markets. And I'm going to do that in two parts today. Firstly, I'm going to have a little monologue, just a chat with you and me about my thoughts about what this means. And then I'm going to replay an interview I did just recently with Dr. Andrew Wilson. Now, every Monday, Dr. Andrew Wilson and I get together and produce our Property Insider chats, which is different to this Michael Yardney podcast. So I wanted to replay that for you, my audience here, so that you can hear what Andrew Wilson had to say about the election. But we also then dig into much more detail about the rental markets, but also about inflation, what that means, what we believe the latest inflation figures are going to mean for interest rates, and how the auction markets are giving us a good indication of what's ahead. So it's a slightly longer show today, but lots of great information if you're interested in property and what the recent election results mean for you. Boy, have we got lots for you. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, the election results are in. The Labor Party has won, and it's in the midst of Australia facing a housing crisis. So if you're hoping the new government is going to be giving us a solution, I hate to break it to you, they might just make things worse. In fact, I think they will. You see, Labor's fresh election win has been greeted with lots of optimism, especially around their promise to tackle housing affordability. But when you look past the headlines and you look into the details, it becomes clear that their policies are just going to pour petrol on the flames of an already raging fire of a housing crisis. You see, we've already got an undersupplied rental market. Construction costs are going through the roof. Builders are going bust left, right and centre. We've got a skilled trade shortage. Yet somehow the government thinks now is the time to ambitiously target building 1.2 million new homes, a figure that's more fantasy than feasible. At the same time, they're flirting with policies that punish the very investors who provide rental accommodation, thinking about adding further compliance burdens. And all this is while encouraging strong migration and population growth that's only going to increase housing demand. It's a classic case of good intention with potentially disastrous outcomes. If you take a closer look and remove the political spin, it's clear that while Labor's policies might well be well-meaning, they're largely demand-side focused. In other words, they're going to increase demand without meaningfully addressing the chronic supply shortage that's plaguing housing markets right around Australia. And as a result, we're likely to see even more pressure on property prices in the years ahead. So let's just take a moment to unpack why I'm saying this. Well, first of all, Labor's promised to significantly expand its help to first home buyers. And that's good, but it's good for the current people wanting to get in the market. But what's it going to do to a housing market? Let me explain. They're going to allow first home buyers to purchase a home with a 5% deposit without needing to pay expensive lenders' mortgage insurance. They've raised the price cap on many regions, being even more expensive properties are now going to qualify for assistance, and that's good. But in Melbourne, for example, where the price cap's $1 million, if you've got a $50,000 deposit and $50,000 or so stamp duty, you can actually get into the property market by $1 million property. Of course, you're still going to have to be able to meet serviceability criteria, but the bottom line is this is going to flame the market in the, market up to $1 million in Melbourne and $1.5 million in Sydney, and different limits in each state, because we know it from the past. When you give first home buyers or anybody an incentive, they use it, they spend it, and it goes up. So this is more than a first home buyer grant. It's an established homeowner boost, because people are going to sell their properties to these buyers, take the money and upgrade their homes. So That's one element. There's also the existing Help to Buy shared equity scheme where the government goes partners with you. That's also being broadened. So on the surface, this sounds wonderful for aspiring homeowners, but economically it's a recipe for disaster. By injecting more buyers into a market with easier access to credit, that just turbocharges demand. I've seen it before. We've seen it before, because if you don't add significant new stock, immediately buyers just push up property values, and that leads to price inflation. Also, there's going to be the next round of home buyers who are going to be left behind. It's kicking the affordability issue, the can down the road. So Labor's policies address affordability for individuals in the short term, but it's going to worsen affordability systemically over the long term. Labor's also announced its immigration policies. They're saying they're not going to slow immigration. Now, if you've been listening to me with my Demographics Decoded podcast with Simon Kirstenmacher, hey, if you don't subscribe to that, you should. It's a separate podcast where we talk about the demographic changes that are going to affect your future. We believe that both sides of government, whichever party in this now decided who it's going to be, probably for quite some time, can't afford to lower immigration. We need to replace the retiring baby boomers and the millennials leaving the workforce, and we need to bring in more workers. So Labor's made it clear it's not going to slow immigration. It's forecast to remain high. About 1.8 million new immigrants are expected to come to Australia in the next 5 years. 1.8 million new immigrants in the next 5 years. Now, of course, this includes international students, but students have to live somewhere, and so therefore they take up accommodation as well. Skilled migrants are going to come in, and there'll be a small amount of family reunification. There's no question that immigration is vital for Australia's economy, especially to fill workplace shortages. But in the context of an already undersupplied housing market, it just pushes further demand without, as I kept saying, giving extra supply. Most new migrants settle in Melbourne, Sydney and Brisbane, the same cities that are already experiencing severe housing shortages. As I've explained many times in Property Update, my daily newsletter, on this podcast, we simply can't accommodate the record migration flows when we're not building enough accommodation. So Labor's failure to meaningfully tie the immigration policy to a housing policy or to realities of housing supply are just going to add further fuel to an already stretched property market. And Labor's supply side solutions are too small and too slow. Look, to be fair, Labor, they're not silly. They recognise we've got a supply problem, but proposed solutions are simply not enough, or they're not going to happen fast enough to matter. They've got a $10 billion Housing Australia Future Fund, and that aims to build 30,000 new social and affordable homes over the next 5 years. Over 5 years, that's only 6,000 social and affordable homes a year. And that's a disgrace. We don't have enough social housing. There's always going to be disenfranchised people in Australia who are going to need the government to help support them. And an additional 100,000 new homes are promised under various state and federal partnerships for first home buyers as well. Look, but here's the reality. Australia already has an undersupply of properties. It needs around 240,000 new dwellings a year just to meet the current population growth. Is an undersupply at the moment. And that's probably a conservative figure. Currently, we're building fewer than 170,000 new dwellings a year. So even if Labor does somehow or other deliver the promised new homes, and that's not guaranteed because they're not going to build any homes. They've got to encourage builders, developers to do that. And at the moment, it's not financially feasible to do it. But even if it does deliver all those homes, barely makes a dent in the supply. And let's not forget the headwinds. There's a severe shortage of skilled labour in Australia. Soaring construction costs, they've gone up about 30% over the last 3 years, which mean they're not growing as much now. But what it does mean is that all the new dwellings that come on the market, especially apartments, especially a lot of those medium density and high-rise apartments that the government's wanting us to build, they're going to have to cost significantly more because it costs a lot more to build an apartment, especially if it's multi-story, especially if there's lifts and cranes involved, especially if there's unions involved. Construction costs are going to mean that new accommodation, new dwellings are going to cost a lot more. And then there's the ongoing supply bottlenecks and planning bottlenecks, and then In the areas where we need it the most, in the medium density, in the middle ring suburbs, there's the NIMBYs and local council resisting development. In other words, the government's supply side solution are really just a drop in the ocean compared to the tsunami of new demand that they're encouraging. But there's another hidden problem. You see, while the federal government's throwing money at housing supply, there's something that isn't talked about a lot. A huge chunk of the cost of building any new home isn't labour, isn't materials, isn't the land. It's the taxes, the levies and the charges paid straight to the state governments. Many years ago, and I've been involved in property development for 40 years, and I've developed a number of housing estates as well, an industrial estate and a residential, small estates, providing the infrastructure for these, things like roads, like water, like sewerage, or like parks for bigger estates. They were seen as the state's government's responsibility, but not anymore. They've shifted the cost onto developers who actually pass it on to buyers. So in reality, any federal funding aimed at boosting housing supply is a backdoor subsidy to the states, helping them to maintain their revenue streams, not necessarily to build more homes faster. And even if the money was perfectly targeted, there's a bigger problem. Who's actually going to build those homes? So just to make it clear before I go on to that, a huge chunk, and I've read somewhere it could be $300,000, $400,000 of every new home, actually goes into taxes, state taxes. And that's sure to supply the infrastructure, but now it's the end user paying for it as opposed to the government. But as I said a second ago, who's going to build these homes? At the moment, the construction industry is already stretched thin. Most tradies are tied up building roads, tunnels and bridges, thanks to the massive public infrastructure boom that we've got, while the residential construction sector is bleeding skilled workers. There simply aren't enough people able to deliver the number of homes we urgently need. And why? Well, I guess the two main pipelines for construction workers, apprenticeships and migration, are broken. Apprentice numbers have been falling for years and the system isn't producing enough tradies. Now, yes, there has been some talk about tweaking this. And also immigration settings have failed. They've failed to bring in enough skilled construction workers, those that we desperately need. So while Labor says it plans to tweak the immigration system to prioritise more tradies, nothing concrete's been announced yet as far as I know. Special visas seem to be on the way out, and while we're talking about including construction skills in permanent migration intake, it's all vague promises at this stage. And the same talk about allowing and helping people become trades, and I think that's a great idea with encouraging more tradespeople. The problem is that's going to take quite some time for them to go through their apprenticeships or go through trade. So these are, again, examples of well-meaning policies. They look good on paper, but they won't fix the real structural problems driving Australia's housing crisis. So I see a real risk that we're going to have a two-speed housing market. Well-located properties in our capital cities, Melbourne, Sydney, Brisbane, will become even more expensive. And it will start off with the lower end of the market, properties up to $1 million, 800,000, depending which state you're in, where the first home buyers are going to be targeting those properties. And then it's not investors going to sell up, because investors now realise that rents are going up and property values are going up. So it's homeowners who are trading up, trading down, downsizing, moving into state, that are selling their properties to these first home buyers. But those who are going to get more money with the extra that the first home buyers are going to pay them are going to upgrade, and so it's going to move further up the ladder. The ripple effect of the rising tide lifts all ships. This is going to help some people get into the market, but it's also going to deepen the wealth gap between existing property owners and those trying to break into the property markets in the future. It's going to put enormous pressure on renters as demand spills into our rental sectors. Tight vacancy rates are going to push rents up even higher. It's a phenomenon we're already seeing. So what needs to happen instead? Now, the government's not going to listen to me, and I don't know all the answers either, but we recognise that neither of the parties went into this election with the aim of making properties more affordable. They didn't want to, they couldn't afford to disenfranchise that 70% of Australians who already own a home or are paying off their home. So no government wants to be in power as property values fall. So what should they do instead? They need to increase supply. We've got to in somehow or other accelerate approvals of new housing developments, particularly infill developments in established suburbs rather than going further and further out, because there's also there's, I guess, some ready infrastructure there. They've got the government should massively invest in infrastructure to unlock new suburbs for development. And if they invest in the infrastructure rather than passing that cost on to developers who are going to pass it on to the end users, we're going to have more affordable housing. And they've got to incentivize the private sector, and they're starting to do that with build to rent and to help more affordable housing projects. And in my mind, and call me biased, they've really got to incentivize private property investors, people like you and me, to provide rental accommodation for that third of Australians who not only, well, at the moment, some of them are not able to buy, but others actually don't want to buy at the moment. They're not ready at that stage of their life. But I believe they should be incentivizing property investors rather than taxing them. Simply helping more buyers get loans doesn't solve the problem. It just creates more competition for too few homes. The only real lasting solution is to build more accommodation faster, but also in the right place. So from an investor's point of view, I see this creating opportunity. In the short term, demand and restricted supply is going to increase price growth. The problem is that until property values go up, a lot of people are going to just sit in the sidelines waiting to see how it all works. But I've seen this before in previous cycles and previously when there's been first homeowner grants. A lot of these grants the 5% grants are going to come in January 2026. So what's that, 7 months away? So I see a window of opportunity at the moment to get in before buyers come into the market and there's more competition and prices start rising, and then FOMO is going to start occurring. Of course, at the same time, we're going to have a number of interest rate falls. The first one is likely to be in May, and the money market's counting in, some saying 3, others even another 4 interest rate falls. Whatever it is, interest rates are going to fall, money is going to become cheaper, but that's also going to increase confidence for people who now think, well, at least I'm not going to be caught by higher interest rates. So there's a window of opportunity to get in before the herd. This is the time that wealth is being created. Not trying to time the market, but if you're currently ready, I suggest you have a wealth discovery chat with one of the team at Metropole, where we can have a chance to understand where you are, where you want to get to, and how to take advantage of it. I don't know your personal circumstances. I don't know if you should invest or even where you should, but we don't have any properties for sale at Metropole. So what we would be doing is sitting down with you, explaining in detail why we believe certain segments of the market are going to outperform, and find out what your finance capacity is, what your risk profile is, what your timeframes are, and then help you build a strategic. We help you plan to become the property investor you plan to become. Not all properties are going to increase in value. I believe moving forward, investors need to be highly selective, and not all properties will benefit equally from this either. Strategic investment grade assets in supply constrained locations are going to be the winners, while poor quality stock will increasingly be left behind. I see an opportunity that we haven't seen for a couple of years now to get in this early stage of what's going to be, in my mind, a sustained growth, not a boom, but a sustained period of growth underpinned by the fundamentals I've mentioned a few times: strong population growth, strong demand, a whole lot of immigrants who came to Australia a couple of years ago who rent for the first couple of years, and they're going to want to get into the property market as well. So that's going to underpin demand for new properties, falling interest rates, increasing confidence. The world's going to sort out its geopolitical problems and life is going to move on. And all it means is property values are going to increase. So I see 3 or 4 years of strong growth in selected markets. So why not take advantage of this window of opportunity and organise a confidential chat with one of Metropole's wealth strategists to discuss your options? Just go to metropole.com.au and organise a wealth discovery chat. Well, it's certainly been a big week in property, with the Labor Party securing another term in government following the federal election. And now there's plenty of speculation about what that may mean for our economy, interest rates, and of course, the property markets. So today, before we dive into the latest data and trends, I want to unpack what this election could mean for property investors, home buyers, and renters across the country, and what the likely implications could be for inflation, interest rates, and affordability. And of course, to help make sense of it all, I'm joined by Australia's leading housing economist Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, g'day, Michael. And yes, it's been not just a busy week, but a busy month. Now we're into May. So with the exception of Queensland, of course, we've got all our public holidays behind us. So, and it has been quite a month of public holidays and diversions, if we count election night as one of those. And so perhaps we can get back to a bit more of a normal environment in terms of housing market activity before we move through into the quieter winter months. But I'm not so sure we're going to see much difference in our markets according to the political climate going forward. And I was shaking my head in relation to some of those policies that were promoted by both parties in terms of housing market activity. They still haven't fixed supply. They won't fix supply. They're just making people happier by giving a smaller proportion of people the opportunity to purchase what will be to purchase homes, but what will be at certainly higher prices, I would suggest.
Well, if you give first home buyers the ability to buy $1 million home with a $50,000 deposit plus stamp duty, of course you've got to have income, you've got to have serviceability. I can see that putting a fire under the lower end of the market. Having said that, they've also raised the bar for what first home buyers can buy, and it varies from state to state. But as you correctly say, there's no answer to the supply situation, and no one's actually even held them to account at that unrealistic idea of building 1.2 million homes. We're not getting anywhere near that, are we, Andrew?
No, it was just a silly promise or a silly speculative thought bubble, and nobody seems to have questioned them because they're miles behind that target. Of course, the federal government can do nothing about supply. It's a state and local government responsibility, but they can make silly promises. And unfortunately, the electorate don't seem to have the capacity or the insight to hold them accountable for that. But it'll only mean higher prices and higher rents going forward, but we should be used to that. And we're not alone, of course. Most Western countries are suffering these same problems, but a number of other jurisdictions have been held accountable in the ballot box, but our government wasn't.
We're going to hone into the rental markets in a moment, inflation and what that means, and clearly there would be implications for interest rates for that, and a few other ideas about the housing market. But are there any other thoughts you've got before we dig into the data about what the election could mean moving forward?
Well, we're in the hands of the international environment in terms of the big picture, Michael. Interest rates, the government's already had its gift in terms of interest rates, courtesy of the Reserve Bank in February, which quite remarkably decided to cut rates in one of the strongest economic environments that we've ever experienced. But good luck to the Labor Party for that benefit. And of course, they also provided those lower electricity prices a year ago, or going on to a year ago, with the electricity handout, and that had a significant impact on inflation. But of course, it won't continue. It was a one-off, but it's achieved the result that the Labor Party were looking for, and that was lower inflation, which has activated the Reserve Bank despite how strong our economy is. The question is, will they cut rates again in a week's time, Michael? Well, the drums seem to be beating very loudly that they will, but the horse has bolted in terms of the influence on, I guess, the election campaign. People would have been feeling better with lower interest rates, and we're already seeing, as we discussed last week, Michael, the predictable impact of lower interest rates on the housing market, and we're seeing higher prices coming through again, and that will continue. And of course, in spades, if we get another interest rate cut, which seems pretty likely in a week's time. Before
we get into what's happening in the housing market, let's continue with the thought about inflation and interest rates, because last week the March quarter headline inflation came in steady at 2.4% compared to December. And these are the quarterly figures that the Reserve Bank's more interested in than the, I guess, more up-to-date monthly figures, Andrew.
Yes, but they should be more interested in the monthly figures, because the quarterly figures are backward looking. It's the monthly figures, and we'll look at the monthly figures versus the quarterly figures shortly. But it's the monthly figures that give us a real sense of how inflation is tracking. And certainly the international environment to this point is working in favour of lower inflation. We'll look at some of the the contributing factors to lower inflation. But, we have the issues with tariffs on the horizon, which, according to most of the so-called experts, will mean higher prices and therefore higher inflation. The expert view on tariffs isn't really panning out, Michael, because it was supposed to create a crack in the US economy over April, but the US economy is continuing to go gangbusters. So there's a little bit of egg scraping off faces going on with some of the doom and gloom predictions in relation to the prospects for the economic prospects with tariffs, even though they really haven't begun. But we shouldn't be surprised at that. We're a hostage to the doom and gloom and clickbait from the media. And unfortunately, Joe Public and Joanne Public out there buy into that sooner rather than later. But I think that, the prospects for continuing lower inflation are very real, particularly given the collapse we've seen in the price of oil. And we'll look at that specifically in just a minute.
Let's talk about inflation, Andrew, because you said there was a lot of negative news in the media, and there definitely was, but there was also some positive news that inflation is now within the Reserve Bank's target range, which could give them the permission to lower interest rates at their meeting in May.
Well, that's right. It's not at the midpoint. When we look at underlying inflation, it was steady at 2.7%. So I guess, that's the midpoint, isn't it? But the Reserve Bank has been telling us that it needs to have that position or heading sustainably towards the midpoint. It certainly has moved sustainably towards the midpoint. I mean, what does sustainably mean, Michael? Is it going to last for a month or 6 months or a year? It's a sort of, an exercise in pedantics, I think. But certainly the monthly numbers now stuck, and it's underlying inflation, the trimmed mean that the Reserve Bank looks at, are now stuck at 2.7%. And when we look at the monthly data shortly, we'll see that the prospects are that will continue to fall because the price of oil is now under $60 US a barrel, Michael, which is we've got a 50 in front of it, and that's been because of the concerns over the US tariff policy. But
let's look at those monthly inflation figures then, Andrew, and what do you make of those?
Well, the monthly inflation figures, we saw that headline inflation was steady at 2.4%, and that's certainly well within the target range. But this is headline inflation, and this is monthly data, Michael. So as we've just already explained, the Reserve Bank focuses on the quarterly data. Underlying inflation was also steady at 2.7%. So these are good numbers, all within what the Reserve Bank has been saying is has as its target, well within the midpoint. The subsidy for electricity, which has been driving inflation down over the past year, wasn't as strong. Over March, it was down by 13.2%, the annual growth rate. Fell by 13.2% over February, but it was down to 9.6%. But that was offset by an improvement in fuel prices. They fell by 5.5% over the year, compared to a decline in the impact of electricity prices was offset by an improvement with fuel prices, and rents also improved from 5.5% annual increase over February to 2%, and underlying inflation is well and truly in the target range on a monthly basis. But of course, we need to look at the quarterly data set, and we've seen that the trend in underlying monthly inflation moving steadily into the target range. So maybe we can say that's sustainable, Michael. But we can also look at what's happened. Of course, we're looking at March data here. We can also look at what's happened over the past month. We're out of April now, and we're still seeing falling international oil prices. So the prospects now for the April inflation rate are again positive, because we'll see another decline in the price of oil. In fact, over April, the international price of oil is now 25% lower than where it was over April last year, Michael. So you can bank in another positive result for inflation. That is, if we continue to get the same impact from the electricity subsidy, which of course will now start to decline. But of course, we've got our election behind us. I'm not sure we'll get another subsidy anytime soon, but we'll wait and see.
Okay. Each month we also discuss the rental market data that My Housing Market breaks down by state and by houses and by apartments. What's happening in our rental markets, Andrew?
Well, we've already discussed the April holiday month, Michael, which we do every year, and there's a lot of distractions that occur. We've had a particularly distractive, is that a word, month this April, because we had a later Easter, which backed straight onto the Anzac Day long weekend, which backed straight onto Election Day, National Election Day. So it has been one of those months where it's, you've probably forgotten what your boss looks like. But nonetheless, that's had an impact on the rental market because of less demand, of course, with those distractions to prospective tenants. So that means we've seen an across-the-board increase in vacancy rates. So still quite low vacancy rates, but certainly with less demand, as we would expect over April, that means there's been more properties vacant. But now, as I mentioned, we've got May approaching. Well, it's here now, and
Yes.
That will mean a more focused market with all those holidays behind us, with the exception of Labor Day in Queensland, which is being celebrated this week. But the numbers, as I said, the outstanding results were that we saw every capital city, with the exception of Canberra, with vacancy rates higher over the month. Canberra was steady. Vacancy rates for houses are still low. All capitals are below 1% and significantly below below 2% and significantly below 2%, with the exception of Canberra, which is still below 2%, but at 1.9%. Not a lot of movement in rents over the month, with the exception of Darwin, which fell 8.5%, but that is a volatile market both for rents and prices. Hobart was also down 1.5%, but the biggest mover was Adelaide, up just 0.6%. Most of the other capitals were either steady, with the exception of Sydney, up by just 0.3%. The leaders in house rents still remain Perth, Adelaide and Hobart over the past year, with Perth the leader, up by 6.9%, Michael. Similar results for units. Vacancy rates higher everywhere except Darwin, which was steady. Vacancy rates a little bit higher for units compared to houses. Melbourne vacancy rate and Canberra vacancy rates are above 2%, just above 2%, 2.4% at Canberra and 2.2% for Melbourne. We mentioned that 2% benchmark, Michael, because that's typically where we see sort of the balance between higher rents and lower rents. Once we start moving above 2% consistently, we typically see lower rents, but below 2% consistently means typically higher rents. And we've seen that for a couple of years now, and that's why we've experienced those higher rents. But in terms of movements for rents, we saw Brisbane, that rental market in Brisbane for units keeps on keeping on, up by 2.8% over the month. Hobart up 3.1%. Sydney remains the most expensive place to rent a unit, as it is for a house, with median asking rents in Sydney at $750 a week for units. And similar to houses, the big rise over the past year in unit rents has been Adelaide, up by 8.2% of the major capitals, Perth up 8.3%, with Hobart up 11.1%, Michael. So a seasonal month, April, no surprises there. We move into a more, I guess, reliable environment for supply and demand in May. So it'll be interesting to see if we track back. But even though we did see an easing in vacancy rates over the month, it was really due to seasonal factors. Vacancy rates still remain quite low and certainly in favour of landlords, and most markets are a challenge continuing for tenants.
Andrew, each week we discuss the auction results because, as I keep saying, it gives us a good indication of how things are happening on the ground, how buyers and sellers are feeling. One thing I was a bit surprised with was how many vendors were brave enough to put their properties on the market for auction on Election Day.
Well, we had another distracted week, I guess, Michael, you'd say, with the National Election Day. But it was interesting that we saw markets, not surprisingly, of course, following the Anzac Day long weekend, strengthen in terms of auction numbers. The auction numbers were generally higher everywhere. Sydney had 552 auctions, up from 368. Another robust clearance rate for the Sydney market, 72.7%. The Sydney market's been tracking, higher this year than where it finished last year, and continuing to track at the same levels as a year ago, which was quite a strong period for that Sydney market. But Melbourne was the big surprise at the weekend, Michael, or over the past week. Auction numbers up, of course, as we would expect following the Anzac Day long weekend, but 775 auctions, but a 74.8% clearance rate, Michael, which is the highest Melbourne has recorded for quite some time. It's sort of been threatening the Melbourne market.
Hasn't it?
A little lower over the past few weeks, but 74.8% is really getting there. Now, we need to wait for a few more weeks, Michael, before we can call it. But I sort of double-checked most of the figures, of course, and it was even the regions were all, quite higher than where they've been. So it was a big weekend for buyers in Melbourne, Michael, despite being election day on Saturday. 74.8%. Brisbane clearance rate also up 45.4% versus 37.5%, which is a good result for Brisbane, which typically has lower clearance rates. And more auctions, a handful of auctions higher than the week before. Adelaide, it was down, which sort of broke the trend with the other capitals. Its clearance rate was 58.6% versus 71.2%. And conversely to Melbourne, Michael, Adelaide was actually one of the lowest clearance rates it's had for some time. Of course, that's been a boom market. And following on most of the other capitals, Canberra also had a higher clearance rate from higher auction numbers. So some good signs there, I guess, if you're a seller in terms of what's happening with auction markets, Michael. But a real standout, that Melbourne result, Michael, over 70%. So we need to wait with bated breath for this week's auction results out of Melbourne to see if what has been threatening an improvement in that Melbourne market is now quite clearly up and running. But we'll need a few more weeks to be able to call it at this stage. But yeah, generally higher auction numbers following that lengthy holiday break through April and higher clearance rates, Michael, with the exception of Adelaide.
Well, as always, we're going to be back each week and we'll keep discussing the auction clearance rates, but what's happening in the market in general. And there are continual hints that Melbourne is finally starting to get its mojo back after a prolonged period of, very sluggish, languishing results. Thank you for your thoughts and your commentary, Andrew. Look forward to catching up with you again next week.
And just before you go, Michael, just on the Melbourne market, Melbourne is always the epicentre of first home buyer activity. So, if there is any bounce from the policies of the newly elected Labor government, that could add a bit more fuel to that Melbourne fire, which seems to be just burning a little brighter at the moment.
Well, let's watch this space. Thanks, Andrew.
Thanks, Michael.
Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?